Good afternoon, everyone. Welcome to this TradeStation webinar. For those that are new to our webinar series, my name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. For me, it's always a pleasure to be talking to everyone here about TradeStation platform. I see some familiar names in the list of attendees, so welcome everyone, and thank you for taking time out of your schedules to be here and enjoy the content that we've prepared for you today. This series is titled Options Replay, Strategizing Your Options Trades. So we look at what the market is doing either today or the prior days and discuss the trades that would have worked or not worked and the reasons why a trade would have worked or not worked. And for that, we have a guest speaker. He's Brandon Wendell. If you've been in some of his series, you probably know him already. He's a great trader and educator, and we are very happy to have him today. But before I transfer or move the microphone over to him, let's go through some of the disclosures of this class. Just keep in mind that every symbol and idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation, and that active trading is not suitable for everyone, especially when it comes to trading options, which carry a high degree of risk. I also want to say that Brandon, even though it's a great pleasure to have him today, he's not affiliated with TradeStation, and we're happy to have him as an educator here on the TradeStation platform. I'm going to show you where to find the options replay recordings. So this is TradeStation.com. You hover over Learn, and you come here to Options Education. Options Education is a place where we post articles, videos, workspaces, custom studies. So make sure that you come here to Options Education and explore everything that we have here. If you scroll down a little bit on this page, you're going to find this banner that says Options Replay. And when you click on Watch Previous, it'll give you in a bigger box, this bigger box that shows up right here at the top is going to be the most recent presentation recording that we have available. But if you scroll down, you'll find a lot of the historical presentations that we've done in this series, and they are titled according to the topics that are discussed. So it'll give you an idea of what was covered. They're not all titled Options Replay, so that way you can see if there's something that catches your eye and you'd like to, read on a little bit more. Okay, Brandon, welcome to this presentation, and I'm just gonna pass it on to you. Okay.
Thank you very much for having me. And looks like everything's good here, so I can go ahead and share my desktop with everyone. So welcome back to everyone, first of all. Hopefully everybody's having a great day, great week, and great trading, more importantly. So let me go ahead. There it is. And yeah, so we're looking at the OptionStation Pro. And today I figured we'd go ahead and talk a little bit more about planning and executing stops to kind of protect ourselves when it comes to our positions that we put in. We talked before about some of the spreads, the straddle specifically, when I was using Hershey as an example here, and I actually still have one straddle open for the May 160s. Take a look to see currently underlying is at 178, so that's a small profit going on in the position. Obviously it is trading higher than the 160, so the call has intrinsic value. It shows you in the money amount 1809, and the put is obviously out of the money, so it has zero intrinsic value, but still has time value left. And if we're trying to figure out when we're getting into a position, we should know several things about our position. That is actually before we enter the position. We should know what is our potential profit for that position and what is our potential risk for that position. And are we okay with the amount of risk we're willing to take? Now, I know a lot of people, when they get into trades, say, for instance, they're looking to buy a call because they think the price of the underlying is going up. They just go ahead and buy the call. And they think that, okay, when it gets to a certain point, I'm just going to go ahead and sell. Well, you've got to make sure that you know what you're risking. And I know that once you get into a call, for instance, let me just, instead of just talking about it, bring up an example. So I click on my options here, and I happen to be on WBA. It doesn't matter what security, but it's Walgreens Boots Alliance. If I were to click on the 10.5s, it should load up the position. And by clicking on the ask price, it should be bringing up an order box for me to be able to buy. Hopefully, let's see, is it going to? There we go. Now it should work. And the option is only 91 cents. So most people see that and they think, well, 91 cents, my max risk is $91 because again, it's 100 shares. That's actually the natural, or no, I'm sorry, it's showing mid 88, natural is 91. So if I did that natural price and put in that order, I mean, it already shows max loss right here of $91. And they think, okay, that's it. I'm risking 91 bucks. But that's not true. You don't have to lose 100%. Oh, sorry. You don't have to lose 100% of your money when it comes to buying the option. Anyway, we don't have to risk 100%. Yeah, I'm going to have to do something here real quick. Anyway, we don't have to risk 100% of our premium, even if we're buying an option. That is always our maximum risk, but is not necessarily what we have to lose. We can set up stop losses based on where we expect prices to go or not go and adjust as necessary. I mentioned a couple times the way I trade is I'm looking for areas to buy based on the trend or areas to sell based on the trend. And I enter at areas of supply and demand. As I mentioned before, it's a little bit different than the traditional support and resistance. I use what's called supply and demand, looking at imbalances in order flow. So if I'm buying at an area of demand, for instance, in an uptrend, meaning if prices pull back to an area where I can buy, I'm going to exit or give up on the trade if that area of demand does not hold. So I'm just trying to, again, see, move this over. And it's not even showing TradeStation open as my process is now.
This in this class, Brandon is going to take a look at not only equity options but also futures options. They're traded very similarly in the sense that the strategies are very similar. Of course, the specifications are going to be a little bit different, but Brandon is going to go into detail about that. And we thought that in the mix of options replay, we're going to do one dedicated options replay that is all futures focused. So if you guys haven't traded futures options before, this is maybe an opportunity just to look at that product and see if it's something that you can add to your strategy. So your computer's back up.
I think so. There we go. So hopefully you guys can hear me. I am on a different computer now, and this one should be running a little bit smoother, more computing power. It's a brand new computer, actually. So let me get my TradeStation running here real quick. Should be loading up right now, and then we'll get back into this. So I apologize for the technology issue, but again, got backup, so we're okay. There we go. So anyway, going into Option Station Pro, and yeah, this is running much, much smoother as soon as this boots up. Basically, what I was saying is that we do not have to risk 100% of any kind of capital that we have, and we never should, to be honest with you. When we're looking at getting into a position, I was suggesting that, okay, we might identify an opportunity somewhere to buy, and we want to buy when prices come into our buy zone, whether it be a support level, demand, whatever it may be. And if that level doesn't work, we just need to say, okay, we have to get out. It's just not working properly, and cut our losses and minimize the risk that we have in any position. And there's easy ways to do that with TradeStation. And what I was going to say, again, I was looking at WBA. So it doesn't matter which security I go to. I'll go to Apple, just randomly off the top of my head, pick that. And going into that, let's say I'm looking at buying a call, and I have to filter this. It was on the Iron Condor. So let's just say we're interested in buying this because we think it's going to go up from $245. Okay, this is not a suggestion. It's not a recommendation. I'm not even looking at the chart right now. So I'm just using this as an example. I want to make that absolutely clear. Now, most people think, okay, well, my max loss, obviously the cost of this right now is $14. And therefore, if I do one of these, it's showing 5, unfortunately. So I have to change my default. One of these, which would cost me around $14 for the natural spread, let me see, I don't have the zoom in on it, is a $1,400 loss. Well, do I really want to take a full $1,400 loss? No, of course I shouldn't. Okay. We need to realistically identify how much are we obviously expecting. Now, it won't be 100% accurate, but what are we expecting to gain from this position? And therefore, how much are we willing to lose? And generally, to be successful in trading, we want to make sure our losses are relatively small compared to the gains that we have. Most people will say you should have at least a 3-to-1 reward to risk ratio, meaning that you are only willing to lose 1/3 of what you were potentially gaining on that one particular security. So if I go back to my charts, let's see, where's my TradeStation? There it is. And I actually do not have workspace open. That's fine. I'll just bring up a chart analysis. That's all I need. And I'll just go to, say, a daily chart and bring up Apple. There we go. And like I said before, I was just using an arbitrary number, not for anything else, of what, $240. So actually, let's use, this area. Actually, I don't want to use any kind of real numbers. Like I said before, this is just for demonstration purposes only. But I'll just say, again, 240 is the area that we're expecting prices to bounce from. And what you'll notice is when I'm using my Fibonacci retracement, I actually modified a little bit. I use 0 and 100 for the levels, or the two levels that I choose. I get bright yellow? Yeah, I guess it is. And thicken the line a little bit. There we go. And set that as default. Labels, let's see. Show price. I do not need to see the value. And we'll make it bold so we can see it. Again, edit that. Labels says default. And right justify. There we go. So what I've done is I've created a tool now instead of using, let me turn off the crosshair. What was this? Anyway, right here, instead of using just one line, I actually use a zone. So I'm trying to find an area where prices are likely to bounce. So again, if I use that 240 and I'm just using approximate 240, 238.26, as long as prices turn in that area, my analysis tells me that we should go up from there. I'm looking to buy when prices come down, and instead of buying the stock, I'm going to be buying the option because I'll get more leverage out of it. I'll get a better rate of return potentially. So whatever reason, I'm substituting an option for buying the stock. And I can do this with a spread as well to reduce my cost. We've talked about that in previous sessions. So if I'm just buying a call, the 240 call, again, and yeah, I can probably adjust the fonts here. Let's see, can I do it? Is this where it is? Font size, yes. Close it out. Option Station Pro. As I was saying, on Apple, if I go out a little bit in time, I'll just use the 81 days and say I want to buy the 240. And right now it's actually, I was using the 245. That's what it was. But let's say I use the 240, 1730. I don't necessarily need to lose $1,700. There's no reason for me to do that. So what I can do then is analyze this. Now, before I go this far, go back one step. And basically, if I know where I'm getting in, I should know where I'm potentially getting out, either for a profit or for a loss. And what I was saying is that for the profit, let me see, new parallel. That didn't go. New parallel. There we are. Hypothetically, if I'm buying at my support or demand zone, I'm going to sell when we get to resistance at, let's say, 257, 258. Okay, I want to get out before I actually hit it, where the selling pressure is still there, but I'm not rushing for the exit with everybody else. So we'll call it 257 for my target. So if I'm getting in around 240, getting out at 257, I can now start adjusting and figuring out how much I'm going to gain at my entry to my target and how much I'm willing to lose. So again, 257 is my target. My entry is around 240, and I'm calling my exit, my quits, if we break this 238.26. So I'll just call it 238 even to make it easy for the numbers. So I do my analysis on my chart, and I get those numbers now in my head. I've got 240 for the entry, 257 to exit, 238 if I'm wrong. Well, let's figure out how much I make or lose based on that if prices get to those areas. So I don't necessarily need the 0 DTE because I'm not going to get out at the expiration. This is a call option that I'm buying. I want to make sure I don't give up all the time value. So I probably will exit when there's at least 30 days left. So I can change on my chart by using the little cogwheel and graph. I can pull this back a little bit until, let's say, there's 35 days left till expiration. Give it a little cushion there. Went 36, 35. There we go. Or I can even adjust the yellow one. Actually, that's probably easier to see. So I'll use that one instead. 36, 35. There we go. And I'll keep the blue right now. And there we are. And then I just simply adjust my price slices. If you don't have enough price slices, then you just add them. You just click add and you can add in price slices. So if I started off with none, obviously I want them. I just click add. So I can first of all figure out this is not the price I'm probably going to pay because I'm not going to enter this position until we actually get to my demand area. Do I use fibs for profit targets? Yes, I do. I use Fibonacci quite a bit, actually, retracements as well as projections, but you got to make sure you use them properly. And there's a whole nuance to that I don't have time to get into right now, unfortunately. But right here, let's say I'm going to get in, like I said, at 240. So by putting that in and adjusting it not to the DTE of 35, but right now, actually, it won't be right now because it's going to take a few days to get to that price. We can even estimate how long it might take to get there. So currently we're at 244. We're asking Apple to drop roughly $5. I'm sorry, no, we're up here, 247. We're asking it to go down $7 before we enter. There's going to be time before that happens. So I can guesstimate based on average true range how long it might take to get there. So this is all just typical technical analysis trying to figure out, okay, if we're going to pull back, When might that happen and how long might it take? And you can even use Fibonacci for that as well. There are Fibonacci retracements, there's Fibonacci time projections, whatever it is that you want to use. I try to keep it simple and I'll just use ATR or average true range right now. And we're not going to get 100% of average true range in our favor every day. Okay. That would basically have candles with no wicks on it, always going in your favor. It doesn't happen unless it's going against you usually. But in general, this is saying right now, and again, let me see, font, sorry, window, there we go. This is saying right now we're moving about, we'll call it $5 a day, okay, on average. Well, I should expect not full $5 on the pullback. Again, we're trying to go $7 total, but maybe, let's see here, I'll bring up a calculator, maybe 70% of that. So 4.75 times 0.7 is $3.30. So roughly, it should move roughly $3.30 every day in that if we're in a downtrend to get to my entry point. Okay. So just to get to my entry point to figure out how long and what prices are going to be when it gets there and I actually enter. This would be much easier if I wait until prices are here, obviously. If I wait till prices are where I want to enter, then I know what the price is going to be. It's what the price happens to be at the time. But I'm trying to figure out, okay, how long is it going to take to get to this point so I can actually enter? So I'm adding a little bit more difficulty to this. But again, I'm just trying to figure out what is this going to cost me, this option, when prices are hitting $240 on the underlying security. So it's going to take at least 3 days. I'll give it a couple extra, just call it 5 days from now, just to guesstimate. Again, these are rough estimates. It's not going to be exact. So instead of my graph being today, I'm going to subtract a few days. So we got 81 minus 5. We'll go to 76 days. I'll give it one extra just in case. And now when prices get to 240, that value, that option should not be $1,700. It should be right around $1,200. It is an approximation. It's not exact. Okay. What I mean by when I enter is if I want to buy an option on Apple right now, I'd be paying an extra premium because it's in the money. I don't want to do that. I want to pay when it's bouncing off of my demand zone. You want to buy low. So I want to buy when Apple drops into this level. That's when I would buy the stock. So instead, I'm buying the call option at a lower price. I'm not paying for all that intrinsic value, and I'm not paying for the time value that was wasted. So I'm trying to guess how long it's going to take to get there, and therefore then understand, let's make it easier. Okay, if I just wanted to enter now, that would be much easier because let's say this is my entry price at 247 and we happen to be there. Okay, so that's all I was trying to do, but I might have made it a little more complicated than I really had to. If you are entering later, like I said, if I'm entering when it gets to 240, I need to figure out approximately what price is going to be when it gets there to do my analysis properly. I can't use the current price because it won't be that when it gets there. You can see that based on my analysis of March 2nd for the entry, the actual value of the option is going to be closer to $1,200, not $1,700, which it is right now. But like I said, to keep it a little bit more simple, let's assume we're getting in now, okay? And actually, we can start fresh. Let's start completely fresh on a different stock, Micron. Let's say we're going to buy at $95. Okay, now I don't need the ATR anymore because we actually happen to be there. So here we are at $95, looking to buy. However, and again, this is a hypothetical. I'm not saying I would do this position because I wouldn't, but I'm suggesting that I want to potentially buy at $95. However, if we break 93.50, I'm wrong and I want to exit. Let's see, data. There we go. Does that make sense? I'm looking to buy this stock, but instead, to get a better return, a little more leverage, I'm going to buy a call option instead. There we go. So $95, I'm in. I'm exiting if it breaks that level because I'm wrong. It's not bouncing. And also, let's see, where's your data? Oh, I forgot where it is now. Oh, that's chart trading. I was trying to turn off the showing the, that's fine. I'll deal with it later. I was trying to take off the seeing the orders there. I forgot how to do it off the top of my head, but that's okay. Anyway, let's say I'm going to exit if we get to 110. So now we got much easier numbers to deal with. I'm buying at 95. If I'm wrong and it breaks 93.50, I wish to exit. However, my target's going to be about $110. Okay. Can you use the underlying stock price as a trigger to buy the call? Yes, you can. Absolutely. And this is going to be pretty similar to what I'm doing right now with the setting the stops as well. So I changed to Micron. So let's do that. MU. I go to my option chain. Actually, first under analysis, everything clear. My trade bar, I want to clear that too. There we go. Perfect. Let me go to options. Now, first things first, if I'm not ready to buy the 95 because it's not at $95, we're actually at 95.40, yes, I can. Right now, I click buy at that limit price, and I could use the natural or the mid. But remember, here's the problem. I don't know what the price is actually going to be. It may be $99.65. It probably will be lower. Okay, so again, I did 81 days again. If I go analyze this, there's the call, right? Now, what is it showing? Yes, 95 call. That's right. It's not a zero to out. And let me change this now because we are doing it currently. So this is current price. There we go. And that's my curve right now for my current price. So if this does go down to 95, and I use the price slice there, you can see that the value is not going to be right now what it is. What, 47.75 is what I'd be paying. No, that's 5 contracts. Sorry, let me do one. I got to change that to $955 is what I'm paying right now, $9.55. But the value, if it gets down to 95, it'll actually drop to about $612. So maybe I only want to buy this with a limit order at 650, since I know it should only be approximately $6.12. So what I can do is set up my order. Oops, again, go back to analysis, bring up my order box here, buy one contract of Micron at $6.50. Now I run the risk of not getting in if the price is higher because of volatility. The volatility might rise as prices go down. I can adjust for that as well in the price slices by changing right here the volatility. Let's say it goes up by 3%, not 300%, that'd be crazy. But 3%, you can see it's still under 650. So I got a pretty good chance of getting filled. But if I want to make sure I get filled, I can actually change this from a limit to a market order. The problem with that is I don't know exactly what I'm getting. So if I want to set up my order to get in, I can either use limit and know how much my maximum payment is going to be, or I can use market. But here's the thing, I go to activation rule, and under activation rule, I click on the little ellipsis button right there. That's what that's called. And I say, enter this when the price of Micron gets less than or equal to 95. That's it. That's all you have to do. Now, if you want to, you can actually put in a couple protections here. If you do, say, double trade tick within NBBO, basically that prevents you from getting a premature entry based on what they call late prints. It doesn't happen as much anymore, but it's still possible. Market makers used to withhold trades or throw in trades late to report. They're required to report every trade that occurs within a certain amount of time. However, the fine is very, very small, so they would hold back these orders sometimes, throw them in late, and trigger people's stops. And that was the problem. You could do the NBBO, and that way 2 trades have to happen within the best bid and offer for that order to actually trigger. And that would basically set up a future order saying, okay, this is good. And you could have to change this good till cancel unless you only want it to be until today at the end of the day. It actually won't take it today because we're after hours now. But if I do good till cancel, basically now this is a limit order for 650 or better. So I'm not going to spend more than $650 to get in, but I will not enter until prices of the underlying security, Micron, get less than or equal to $95, which is where I was looking to buy. And I place the order. It'll say you're placing outside of a session. You want to wait for the next session. I can say, yeah, sure. And that's it. I send the order. And it is pending now. Come on. Now there's a single buy to order, and I can look at all the information on it as well. Now I can do the same thing for my stop. So going back to my analysis, again, I was looking to buy at 95, or if, let's say I'm ready to get in now. Once again, last price is about 95.35, right? And that's DTE 35. Wait a minute. Oh, we want now. Wrong one. There we go. Current price is showing 955. The current value is about 1,000 right now. So I'm actually getting to buy it a little bit cheaper. So if I'm ready to enter right now, I'd be buying at $955, right? Now, what happens if it breaks my demand zone? I said I want to exit if I'm wrong. That would be at 93.50 or lower. And my target is 110. So if I put in 93.50 for one of the slices, I can see what the value of that security would be and how much I would potentially lose That is not including any time or changes in volatility as well, though. I forgot to put in the volatility back to where it was. So you can see this is actually pretty aptly priced, 955, 954 at the current price. But if we drop down to 93.50, I would lose approximately $103. Now, how much am I going to gain if it gets to my target? That was at $110. Well, if it does it today, which is not, but that would be roughly about $1,000 of profit. I don't mind a 10 to 1 reward to risk. That's very, very nice. Okay. So what I could do once I'm in the position, you got to be in the position to do this. But once I'm in the position, let's say I have a position I'm currently in. Actually, I have a micron position on, but that's not what I want to do. Let's say, just trying to find something simple. These are all more advanced. That's equity. Anyway, I'll just use the Hershey example that we went over. I have a call and a put. This was a straddle, I think, that we bought. Yeah, the straddle. So let's say I want to exit this if prices go beyond a certain level. Actually, that's not the one I should do. Do I have a vertical? I do. Right here is a vertical spread. Perfect. I'll use that, CAG. So here I have a vertical spread on CAG. And let's see, chart trading. There we go. And for that vertical spread, it was the 27.28 calls. Oh, it was actually a bearish trade, isn't it? Because I bought a put and I also did a bear call spread, it looks like. Sold the 27, bought the 28s. That's okay. So if this keeps rising, I might want to get out if I get to a certain amount of loss. And what I can do is figure out, well, first of all, on this position, if I analyze the duplicate, there we go. Perfect. I'm analyzing this trade. This is what it looks like. And it's obviously changed the times a little bit because we have now and then day select expiration. This one's expiring kind of soon in March. But if I get to a certain level where I want to exit based on how much I'm willing to gain, to get when I got into this position, let's say what I got, trade price 30 cents. So I was basically making $30 for the profit. That's it. It's just a small trade, one option, or sorry, one bear call spread, bear call spread, and I sold it for 30 cents. I don't want to risk more than 10 cents or $10 to make $30 and maintain that 3 to 1 reward to risk. So I would do the same thing. Under my analysis, I would try to figure out what price would cost me that $10. Now remember, time is going to be moving and we're going to be getting changes in volatility as well, which will raise the value of the options a bit. So if volatility goes up, let's say 3%, I'll use that again, and time goes by, right now we have 25 days left until expiration. I can try it based on today. I just adjust a price slice. Let's see here, we'll do this one. And you can see that at approximately, doesn't have to be exact, $26.68, I will lose $10. So what I can do then is say, and then again, this is approximate, it's not exact. Since I know I'm going to be making no more than $30, I can set up a stop if the price of CAG goes above 26.68. And all I have to do then is go into that position that I have open, right click it again, analyze close or close this position. I'll do close this position. This is in order to close. I could do a limit, but most likely it'd be best if I do market order because I want to get out. This is a stop loss. Now, could I lose more than the $10? Yes, absolutely, I could. But I'm approximating what it would be. I'm going to put this as good till cancel, of course. And this is my stop loss. I've got an open position. This is a buy to close and sell to close. And again, I use the activation rule. So I click on price, CAG, add. If we go greater than or equal to, and I forgot what it was now. I forgot to write it down. It was 26 something. I think it was like 26.32, something like that. I don't remember exactly. It doesn't matter. But that's what I put in. Wherever I'm willing to exit, and that's it. Now I have a stop loss where I will lose approximately 1/3 of what my potential gain was in this position. If I know I'm willing to get out, if I reach a certain amount, right now I'm up only 12.50. It's not even half of my potential profit. If I'm expected to make, maybe I'll be happy with 75% of that $30. I could also put in another activation rule in the same order because this one's just simply to exit. I'm going to exit if prices go too high. And I can put in CAG, add, or, that's important. You got to put it as or because it can't be in two places at once. If we go less than or equal to, and what I would have to do before I get here is figure out what price would give me roughly 75% of $30 for profit. And I also have to make sure I take away some time on that as well, just to, again, it's an approximation, but this allows me to bracket my position so that way if prices go too high, I get out for my loss, but I've limited my loss not to the maximum, but to a smaller amount. And that's something I'm willing to work with. Or if we hit a profit target, I'm also willing to exit. So that I can do and set up both those orders. Again, to figure out exactly what it would be for the exit, cancel this out. I go back to that position and I go analyze duplicate and I just go the other way. Well, what are we looking at here? Again, $30 potential profit times 0.75 and it's 22.50. So I'd slide this to where I'd be making a profit of 22.50. Now, again, I might have to adjust based on time as well. This is showing right now. Oh, no, that's date. Sorry, that's not right now. That's right now. But as time goes by a little bit, and I can adjust this. Let's say we go by 1, 2, 3, 4, 5, 6, 7, 8 days, 9 days. There we go, approximately. And my profit of 22.50 happens at about 24.70. So that's what I would use in the activation rule for that 22.70. So that's a kind of a neat thing about the activation rule. And if you go to the options education for TradeStation, you go TradeStation.com and under learn options education, you actually have a session in there on activation rules. There it is, placing activation rules on options orders. So you can get more information about that right there as well. Now, before I run out of time completely, I did want to go into another little session here. Let me see. And that is it, I think. Let's see if it logs in. May need my phone to get the login. Yeah, I do. I wanted to touch a little bit on something that's kind of exciting that we're going to be doing is a whole session coming up on options on futures, which is pretty cool. If you haven't ever done this before, options on futures gives you, in a way, leverage on leverage, which is something you got to be very, very careful with because you are gearing up your already leveraged security. So, it's trading responsibly. We need to make sure we understand the type of risks that we're taking and how much we're willing to lose. But options on futures are very similar to options on equities, indexes, ETFs, kind of what we were just looking at. The difference is the underlying security. When you're dealing with options on futures, the underlying security is a futures contract. If you're dealing with options on stocks, obviously it is typically 100 shares. So right here, I'm looking at options and let's see, I got NASDAQ. Let's check on that. There we go. So here's the NASDAQ. Basically, when I trade these options on the NASDAQ, let me minimize this for a moment. Nope, not that one. All of them. You can see, I don't know why it's still showing December 24, but you can't trade those anymore. We're currently trading the March and getting ready to go to the June contracts pretty soon. But basically, the big difference you'll notice, and actually, let me go, no, not there. Let me bring up another page just to kind of show you. Let's go nat gas, NG, and there it is, LNE. Now, when you're dealing with options, we all know that you have to deal with the underlying security, and then you have an expiration on the option. When it comes to options on futures, there's options expirations and there's futures expirations. There's two different expiration dates you have to worry about. Oh, great question real quick. Going back, if your loss limit triggers an exit, what happens in a sell order? If it's set on the same order as I was doing with the activation rule, because there are two pieces to it, it cancels the rest of it. It's almost like an OCO. This order triggers with either one of those. But if you did them separately, you'd have to manually cancel. Great question, Ernesto. Yeah, when I was doing that CAG and I was using twice, saying if it went above a certain price or below, either one of those is a trigger to send the order. And there's only one order, but two conditions. So yeah, you don't have to worry about it. There's not another one there. So is it only the cash indexes we can trade in futures? No. When it comes to the futures markets, you have access to pretty much almost all the securities that are available when you trade futures. Now, you got to be careful of liquidity, okay? And the problem is that not everything is liquid. You can't trade everything just because it's there. You got to make sure there's other people trading it as well. This is a similar platform or a different platform. It's called TradeStation Futures Plus. And again, there's a lot of education for that in the TradeStation's website as well. And we're going to be covering more of this in special sessions on options on futures. But yes, if I were to go in, for instance, I've created this tab right here because I wanted to show you a couple things. Notice right here, March, that's the March options on the March contracts. Now, this is probably not the best one to show. It's not showing, let's see. Yeah, because you have April options on the April contracts, May options on the May contracts. Actually, let's go back to net NQ, because sometimes you'll see that the month of the option expiration doesn't match the future expiration. There could be multiple months of options on the same underlying security. Okay, so there are plenty of different things to trade. As I was saying, if I go out here to this little plus sign, look at the list. There are a lot of different futures out there. If I want to trade lean hogs, let's see, HE. Oops, type in H. Oh, it actually might be under the other symbol. I forgot. TradeStation uses the pit symbols versus the Globex symbols. So this might actually be under HE or LH, is it? There it is. We have LH. No, LEHE. Is that it? No, it should be under H, I believe. Where's the LH? I should pick something else that I know the symbol of right now. You can look up the symbols too. Oh, it is LH. Okay. Not sure why it wasn't coming up when I went to that. The only drawback is I got to scroll through these a little bit, but it's not too bad. There's LHN. Let's do LE. That's live cattle since I have that one there. So lean hogs. So I load up LE, and basically what I was trying to show you, here it is. Good example. Notice we have March options, April futures, April options on April futures. That's all I was really trying to show you right there, is that there may be multiple options contracts on the same underlying security. Okay. Now, the way these work is a little bit different as well, especially on the quotes. I'll go back to the NASDAQ because many people are kind of familiar with the NASDAQ. If you've never traded futures before, definitely learn more about the futures, which we'll talk about that in other sessions. But looking at the NASDAQ quote, am I not getting active quote here? There it goes. Now it loaded. I go to the March 2025 options right here. I can minimize the others to keep it clean. And right here, we've got the calls on this side, says C for those are calls, and then P for puts, just as we did on the other platform. However, if I want to buy, let's say the strike price 21,400, and I want to buy the call, it says 464.75. That is not the price that I will actually pay. Remember, just like options on stocks, when you buy an option, if it was $9.50 for one option, that's actually times 100 because you're trading 100 of the underlying. When you're trading futures, you are trading one futures contract. Therefore, whatever price you're getting right here has to be multiplied by the point value of the contract. Well, the point value of the contract for TradeStation, I'm sorry, for the NASDAQ is $20 per point. So if I wish to trade one call right here at 464.50, where's my calculator again? 464.50 times 20, that's $9,200.90 for one call option. Okay. So it's still cheaper though than holding the NASDAQ futures overnight. The NASDAQ futures overnight, I forget exactly what the cost is, but somewhere around $20,000 for the margin for the full size contract. Now, if I wanted to, I could trade the micro. If again, I go in, I bring in another tab here, and we have MNQ somewhere. The M's. Scroll down a little bit, and there we are. Nope, that's NQ. Went too far. There's actually an easier way to do this on the auto spreader. I should probably do that instead. I bring up under widgets. There it is, auto spreader under automation. Create. Oh, no, I'm sorry. That's for the spreads. I was thinking of a different thing. Future spreads. Anyway, again, I can go back and create tab, M. Just scroll down until I get the right one. There is an easier way to do this, and it slips my mind right now, so I apologize. But I can go to the micro. L, we're almost there.
A lot of products here, huh?
There we go, MN, and there it is, MNQ. So I click on MNQ, select, and there are the micros, no problem. So here, there's actually March and June available. And again, looking at these quotes, if I was looking at the 21,400, 471.50, I just multiply that by the point value, which is in this case $2. So I'm paying about $900 for the option rather than $9,000. That's all. But it's very similar, as you can see. So these options trade very similar to what you're seeing when it comes to options on stocks. You can do very similar types of trading on the options on futures. Some of the neat things are there's actually some tools created right here, say, for instance, strategy creation. Now, one of the things I like about trading options is we can create more specific positions where we can trade to profit from time, volatility, or price. And if we're trading, we can start to reduce our risk a little bit by using things such as spreads. So rather than simply buying a call I could actually do, say, a custom right here, buy a call. Oh, that was sell. There you go. Buy a call and perhaps sell a higher strike call. That's a spread. So I can build that spread. Now, it doesn't work, unfortunately, in the simulated mode, but you have what are called the strategy creation tools right here. And when you're live, I could actually create a watch list right now, but I actually have all these templates ready to go. Box, butterflies, condors, diagonals. Go to page 2. Yeah, jelly rolls. You got ratio spreads. I like doing ratio back spreads. A lot of these strategies, straddles, we were talking about those. All you have to do is click on it. I can actually build that option spread right here. Click option, whichever one I want to trade. I think I can also build it. Oh, this is using corn. So again, I can click here and there we go. I can actually scroll down. Letting me do this? No, I just got to scroll. Unfortunately, I was trying to find that live lean hogs again. There's a live cattle. And there may not be a lean. No, lean hog should be tradable, but I don't know. I know the futures are LHJ25. I don't know what the option symbol is. That's the problem. So I'd have to look that one up. But as I was saying, if I wanted to do, let's say the NASDAQ, since it's over here, NQ, NASDAQ 100, March, I can choose my strike, 21,400. And then I can add in option. Again, NQ. I'll just pick one right now, just to make it easy, and then adjust the strike here. So let's say we're doing 21,400 and 22,000 even. That's a call. Change that from put to call. And there's a bull call spread, buying the 21.4, selling the 22,000. And I can put that as a watch, or I can put in the order. Unfortunately, I can't trade it in the simulated mode right now. If I try to do create, it says strategy creation is not supported in simulation. So I have to build the strategy separately, but I can actually put in that watch list that I have and watch that position to see how it is working out, which is pretty cool. So there's a lot of different templates. Unfortunately, I don't have a whole lot of time to go into this right now, but let's see. How do we calculate risk on options on futures trade? Okay. Oh, where do we get the point values? The point values you can find on the CME website. As a matter of fact, if you go to the CME, and I had it saved on my other computer, of course, but you can do a search for contract directory. You see, I've done this before. Contract directory. Just go to the search feature right there, contract directory and calendar tool. And if you're going to trade options on futures, even futures, this is going to be one of your best friends. So remember, I was looking for agriculture and lean hogs. There it is, HE. And there's no symbol. So there may not be options available on that. That's probably why I couldn't find it. Choose a different product. Oh, wait, no, it showed something there. Hold on. It was just taking a while. HEH. Nope, that's the future. No, it is an option. March option, American style. And right here where it says UOM, that is the quantity you're trading. And then you can go to the futures. And right here is where you'll find the ticks and the point values. So if I were looking at, let's say, Forex and, Kiwi, let's click on that. Should load this. It's loading a little slow today. It's really weird. Maybe something is wrong with my computer on this one too. But anyway, let me try a different one. Go to energy, because I know this one I've used a bunch. There we go. This is on nat gas. First of all, it tells me these are European style options. Now, European style options cannot be exercised or assigned early. They can only be assigned or exercised at expiration. So again, as we go into more of the lessons on options on futures, you'll see more about that. But I can go into one of these. Let's say we look at this LN2H5. There's the underlying future, and the underlying future is the April contract. There's my point value right there, 10,000. So if I'm trading the bring up the nat gas futures, NG, it's just here. Let's see, NG, there we go. And it's LNE that I'm going to be trading. Actually, I already had that open. I didn't realize. But when I look at the pricing and the points that show up, there we go, March. And let's say the $4 option, the call, it says 0.1. So whatever that price is, you multiply by the point value. What's that point value? 10,000 right there. Shows me UOM quantity. That's what I multiply by. And then the information on the option right here and how it works. These are financially settled options. Those are cash settled, which is pretty cool. I don't have to worry about delivery in that case. So if I'm trying to calculate the risk on that as well, unfortunately, I'll have to do that a little bit later. But yeah, there's definitely ways of calculating the risk on that. But the neat thing is you can trade these options on futures. A lot of reasons why people trade futures is tax benefits. I'm not a tax professional, so I can't go all into that, but there's some tax benefits typically. Check with a professional to make sure for you. Also, the leverage. When you're dealing with the leverage here, it's pretty incredible. You can get into a lot of these futures that are worth hundreds of thousands of dollars for a much smaller margin amount. Well, with the options, they're even cheaper when it comes to the margin. Again, there's still risk, and you can lose more than what you even use in margin at times, depending on what it is you're trading. So you have to be aware of that and careful with that. But this kind of opens up your whole world. Think about this. If you've got a 401k or an IRA and you're worried about a market crash, there's a limited number of things you can do to protect it. Well, one of the things you can do is maybe go to the NASDAQ or the S&P futures and trade options on those futures to hedge your portfolio. Anyway, those are some of the things that we're going to be exploring in the upcoming series on options on futures. So if you're interested in doing that, learning a little bit more about that, let us know. Well, we're going to be doing it regardless. So I think hopefully you'll be enjoying it. But there's going to be a lot of stuff. I'm going to start off with the basics on options on futures and talk about the differences, some of the benefits, and how to actually function in trading those using this platform with TradeStation Futures Plus. So I got to turn the floor back over to Jesus. Sorry about this. I got to get going. Yeah, I'll see you on Wednesday again. Thank you.
Oh, thank you. Thank you, Brandon, for spending this time with us. It was great information. I know that, Futures Plus has its challenges and sometimes it's hard to find products there. But the good thing is that you figured it out and we were able to do an example there. And yes, we are going to have options replay every 2 weeks. So make sure that you look at the events calendar to see where those dates are going to fall. And we're going to continue doing a dedicated options replay on futures options. So make sure that you check the title of the presentation, because sometimes we'll focus on equities and some other times we'll focus on futures. So thank you everyone for being here today. Have a wonderful afternoon. And if you have any questions about the content or any of our sessions, please email us. Our email address is education@tradestation.com. So great having you all. Brandon, again, thank you for your time. And I'll see everyone at a future event. Goodbye, everyone.